Daily Fiscal Pulse for the 17th of June, 2026. We're looking back one day. Here's where the flow settled through Wednesday's close. Before we dig into the numbers, let's acknowledge what's driving the conversation. Iran and Middle East tensions are the headline risk right now. You're seeing statements like Vance saying the US isn't giving Iran a cent while defending the Trump peace deal, and that's clearly moving markets. Against that backdrop, let's see what the fiscal picture actually shows. The flows landed at $24.3 billion in net transfers. That's stable enough on the surface. What's more telling, though, is the trajectory. Looking at the 5-day average, we're running at roughly half the pace from recent weeks. The story here is household transfers, which came in at $32.6 billion and are driving most of the movement. The ES chart is painting a similar picture. ES futures closed at 7,423, still trading below that 20-day moving average of 7,500. The 20-day range spans 385 points and has been grinding lower. Flows and price are basically saying the same thing right now. When you zoom out, the deceleration becomes pretty clear. Government spending on a 5-day basis is averaging $23.4 billion per day. Now compare that to the 20-day average of $5.5 billion. That's a substantial pullback. The bottom line is straightforward. Less money is flowing into the system. Less cash moving through households and into markets. Financial conditions are tightening as that happens. Year over year, the picture stays consistent. Fiscal year-to-date spending stands at $1,023.7 billion, roughly 6% below the same window a year ago. That's a meaningful cut in fiscal support, and it matters for liquidity conditions. For anyone thinking about long exposure, the fiscal backdrop deserves consideration. It's not exactly supportive right now. Our conditions gauge is at -61. That said, history offers some perspective. We've seen this environment play out many times. Despite tighter liquidity, the S&P has still averaged around plus 1.6% over the following month. Liquidity and price action don't move in lockstep. Markets can grind higher even when cash flow is constrained. The positioning data adds nuance here. Margin debt is sitting at the 100th percentile, which is elevated. Historically, that level tends to be more warning than permission. This is where it ties together. With fiscal flows below last year's levels, the system's shock absorber is thinner. When sentiment is positive, markets can still push higher, but when risk flares up, like an escalation in Iran or the Middle East, the downside can accelerate simply because there's less liquidity sitting underneath to cushion it. A couple of things worth watching. The 24th of June brings the SSA payment cycle, the fourth Wednesday of the month, which tends to reshape short-term flows. So fiscal drag is definitely showing in the data, but the rate of tightening might be beginning to level off. Where we go from here probably hinges on how these upcoming scheduled flows land. That's the setup.